What can I gain from it? Uncover the psychological forces guiding financial decisions. How exactly does the stock market operate? When's the prime timing to buy or sell investments? And how much should you save each year to retire when you want? These are the burning questions that often take center stage in personal finance discussions. However, there's a crucial aspect that tends to be sidelined: the human factor, the intricate link between individuals and their money. Morgan Housel underscores the significance of this factor in understanding financial decisions. To truly grasp why people accumulate debt or squander their wealth, it's essential to look beyond interest rates and delve into the profoundly human history of jealousy, greed, and optimism. This will be the focal point of our upcoming summaries. You'll uncover valuable insights into how personal experiences shape investment decisions, the reality that finding a single success may involve enduring numerous setbacks, and the ways in which envy can drive investors to take risky gambles with their existing assets. Key Concept 1. Everyone's economic and monetary journey is unique. The Great Depression saga is famous. Following 1929's catastrophic stock market collapse, a prolonged global economic downturn ensued. In America, the vibrant 20s abruptly ceased. Enterprises shuttered, families forfeited farms and homes, and life savings evaporated. Poverty and unemployment soared as optimism for a brighter future waned. Today, this account is widely accepted because it reflects the plight of countless Americans. But it misses a vital aspect. The essential idea here: each person's economic and financial journey is unique. When John F. Kennedy campaigned for presidency in 1960, his personal Great Depression experience was unexpected to many. The Kennedys were affluent in 1929, and over the following decade, their wealth didn't dwindle but increased. Kennedy only comprehended the extent of others' suffering when he studied at Harvard. Not all Americans shared the same fate. Kennedy aimed to alter this disparity, which helped persuade voters he was more than an aloof aristocrat. He was a qualified leader. But it's not just the wealthy and poor who have divergent economic experiences. This applies to everyone. For instance, two well-off individuals will have differing financial outlooks based on whether they experienced high inflation or constant prices during their formative years. Such experiences profoundly shape our financial actions. We often believe we understand the world, but our actual exposure to its vastness is limited. Recognizing this is vital when considering money psychology. We know less than we presume. Key Concept 2. Individual experiences dictate financial decisions. Economists often model financial behavior on the notion of rational beings pursuing self-interest for maximum returns, a tidy but unrealistic concept. Take the lottery. For example, low-income U.S. households spend $411 annually on lotto tickets. Yet roughly 40% of households can't muster $400 in a crisis. Often these are the same households buying lottery tickets. Is this rational? Not exactly, but it's not without logic either. For those living paycheck to paycheck with barely enough for essentials, let alone luxuries, lottery offers a slim hope for accessing what wealthier individuals enjoy as standard. The takeaway: personal experiences drive financial decisions. Economists Ulrika Malmendier and Stefan Nagel analyzed decades-long data from the Survey of Consumer Finances to understand investment behaviors. Their discovery? The economic climate during investors' young adulthood shapes their risk attitudes. Someone whose youth coincided with high inflation is unlikely to favor bonds later on, while those who experienced low inflation would be more comfortable investing in them over time, even if inflation rose during their lives. Investment patterns in stocks show similar trends. If the market prospered during one's early adulthood, they're inclined to invest. If not, they typically avoid it. Consider someone born in 1970. During their teens and early 20s, the S&P 500 surged tenfold. Those who invested then reaped substantial rewards. In contrast, those born in 1950 witnessed a stagnant market during their formative years. Notably, investment choices didn't shift even when market conditions changed. Early life experiences strongly influence financial decisions. Economic theories are still relatively new phenomena. The domesticated toy poodle bears little resemblance to its wild forebears or wolves. This shouldn't be shocking since dog breeds have undergone 10,000-year domestication journeys. Yet dog owners are frequently surprised by their pets' primal reactions to squirrels or cats, a sign that millennia haven't fully tempered these deep-seated instincts. But what does this have to do with money psychology? Quite a bit, actually. The central message: economic theories are still relatively new phenomena. Many struggle with money management because it's a recent development in human history. Currency first appeared around 600 BC when King Aliats of Lydia issued coins. Even more complex economic notions are newer still. Consider retirement. Before World War II, most Americans worked until death. The introduction of Social Security post-war began changing this norm. But retirement as a common goal didn't emerge until the 1980s when Social Security payments surpassed $1,000 monthly after inflation adjustments. Prior to that era, only a select few could afford to retire in their mid-60s. Thus, some foundational economic concepts of today are less than 2 generations old. The 401k didn't exist before 1978, and the Roth IRA wasn't introduced until 1998. Other central ideas and practices are similarly youthful. Hedge funds gained traction just a quarter century ago, and index funds are roughly 50 years old. Consumer debts like mortgages, car loans, and credit cards, significant U.S. economic growth drivers, became prevalent only after the 1944 GI Bill facilitated borrowing for average Americans. If financial planning and decision-making prove challenging, it's not due to irrationality, it's our inexperience. Chance plays a significant role in financial triumphs, often underestimated. Nobel laureate economist Robert Shiller once expressed his curiosity about the exact role of luck in successful outcomes, a challenging question given the difficulty in measuring luck's impact on a company's success or failure. While acknowledging luck's theoretical importance, people struggle to quantify its influence, and it's considered impolite to attribute others' achievements to mere chance. Consequently, luck's role in financial decisions is frequently overlooked, a significant oversight. The insight: chance plays a significant role in financial triumphs, often underestimated. Economist Bhaskar Mazumdar found that siblings' income correlation surpasses that of height or weight. In other words, if one sibling is wealthy and tall, the other is likelier to share the wealth than the height. This correlation stems from shared privileges and opportunities within a family. However, wealthy siblings often disbelieve such findings' applicability to them, attributing success to hard work and failure to bad luck, while attributing others' failures to character flaws rather than misfortune. Our success-obsessed culture doesn't help. For example, Forbes celebrates lucky but mediocre investors rather than brilliant ones undone by misfortune. This leaves a conundrum. We need to incorporate randomness into financial models to better understand money management. We might not pinpoint luck's exact role, but we can certainly account for its influence. Key concept: 5 broad trends offer better insights for decision-making than individual cases. Bill Gates remarked that success can mislead by masking luck's role, giving a false sense of invulnerability and potentially leading to failure. So, how do you factor chance into your financial behavior? Avoid focusing solely on specific individuals' examples. This tends to highlight outliers, skewing our perceptions and potentially leading us astray. Consider John D. Rockefeller. His rise involved flouting laws, which we now view as visionary due to his success. Had he failed, would we regard his approach as commendable? Unlikely. What separates these outcomes is often luck, something beyond our control and impossible to replicate. Instead, focus on analyzing patterns of success and failure. The more frequent a pattern, the more relevant it is to your life and financial choices. Research consistently shows that individuals who manage their daily structure report greater job satisfaction, unlike exceptional cases of outliers. This broad observation is actionable immediately. Key concept 6. Jealousy can foster reckless financial behavior. Capitalism excels at creating both wealth and envy. For example, a new baseball player earning $500,000 might feel underpaid next to a superstar like Mike Trout with $36 million annually. High earners like Trout then measure themselves against even wealthier individuals. While envy isn't inherently wrong in capitalist terms, it can lead to impractical decisions. The lesson: jealousy can foster reckless financial behavior. Envy led Rajat Gupta, who rose from Kolkata slums to become McKinsey CEO with a net worth of $100 million upon retirement in 2007, down a perilous path. Yearning for billionaire status, Gupta engaged in insider trading after learning of Warren Buffett's imminent investment in Goldman Sachs during the 2008 crisis. Although he profited initially, illegal trades eventually resulted in prosecution and imprisonment. The story underscores that envy-driven decisions often incur greater losses than potential gains. Recognizing when to resist temptation can prevent regrettable outcomes. Avoid being Rajat Gupta. Key Concept 7. Accumulating wealth is simpler than maintaining it. Jesse Livermore exemplifies this, a renowned early 20th century trader who predicted the 1929 crash and profited massively. However, post-1929 arrogance led to repeated losses and ultimately bankruptcy and suicide. The point: accumulating wealth is simpler than maintaining it. Staying wealthy requires humility and the recognition that luck plays a part in success. There are many Livermores whose stories aren't as dramatic but still reflect the challenge of preserving wealth over time. About 40% of publicly traded companies eventually lose all value. America's Forbes 400 list sees a 20% turnover each decade, excluding deaths and family transfers. How do you retain wealth? Perseverance. Successful entrepreneurs survive long without catastrophic failures. Fear of loss ensures cautious decision-making. Few potential benefits justify risking all you've acquired. This mindset leads to wiser choices. You can afford numerous mistakes if a few successes are significant. Heinz Berggrun's tale illustrates this, starting with a modest Paul Klee painting purchase and eventually amassing a world-renowned modern art collection, later sold to the German government for a fraction of its €1 billion value. The essence: you can afford numerous mistakes if a few successes are significant. Great collectors, like investors, often acquire in bulk, with some pieces appreciating significantly over time. This approach, akin to index funds, spreads risk and waits for winners to emerge, demonstrating that a portfolio's few successes can outweigh many failures. Final insights: the realities of financial decision-making are more complex than economic models suggest. Choices often stem from individual experiences and psychological factors. Embracing luck's role, fearing loss, and diversifying risks are keys to smarter financial strategies. The full audiobook link is in the description below. If you liked the video, consider subscribing. Keep learning and exploring new books. See you next time.